Keep in mind that official economic data lags by as much as 6 months. So we may not know for a fact that we are in a recession until we've already been in one for 6 months or longer. Hi guys, it's Stock Curry, and as stocks continue to fall on recession fears, we're going to take a look at the latest economic data to see how much that recession might be. We've also got to talk about some individual stocks and then some major changes coming to the stock market next year. So let's get into it. Here's the major news moving individual stocks on Monday. Meta Platforms was down over 4% on Monday. This on news that Meta could face an $11.8 billion fine as the European Union charges Meta with breaching antitrust rules. The European Commission said that it found Meta breached European Union antitrust law by distorting competition in the market for online classified ads. The commission took issue with Meta's pairing of the Facebook Marketplace service, which lets users list items for sale with its personal social network, Facebook. Now, it's important to understand that this is just the beginning of an investigation into Facebook. Facebook will still get the opportunity to respond to those accusations with a final ruling coming sometime next year. So this is not guaranteed that Facebook is in trouble or has broken antitrust rules in the European Union, but they are being investigated for doing so, and the maximum fine they could face would be $11.8 billion, or 10% of their revenue in the European Union. And Lucid rose over 7% after hours on really good news. Lucid had been facing bankruptcy because they were nearly out of cash, yet they just closed a $1.5 billion round from the Saudi Public Wealth Fund as well as other investors. This is going to help Lucid starve off bankruptcy for a few more years, which is why the stock rose after hours. And in the cryptocurrency world, Binance.us is acquiring bankrupt crypto exchange Voyager Digital for $1 billion. Anybody who owns shares in Voyager Digital will get their share portion of that $1 billion. This is good news for Voyager Digital as well as crypto exchanges across the board. However, it is important to point out that FTX was also going to bail out Voyager Digital before it turned out that they were bankrupt. Now, there are a lot of concerns about the solvency of Binance.us. There are no guarantees this deal will actually go through. However, it is good news for now. Here's the latest economic news and recession data from the United States. This is a big week for the housing market and housing data here in the U.S. Keep in mind that the housing market makes up more than 30% of the U.S. economy, so it's going to be very important to pay attention to the data that comes out this week so that we can get a better insight into the U.S. economy as well as a possible recession next year. Taking a look at the economic data coming out this week, the Home Builders Sentiment Index was released on Monday. We'll talk about that in just 1 minute. On Tuesday, we get the November data on building permits as well as starts for residential construction. Then on Wednesday, we get existing home sales numbers. And then on Friday, we get new home sales data. On Friday, the Commerce Department is also releasing figures on household spending, income, and inflation for November. All of this data could move the markets this week, and no doubt some of it will be good, some of it will be bad. It's really hard to say where the market's going to go this week, but let's go ahead and talk about the data that came out on Monday. Home builder sentiment dropped for the 12th straight month, but some people believe a bottom may be near. While this is the 12th straight month of declines and the lowest reading since mid-2012, the silver lining in the report is that it's the smallest drop in the index in the past 6 months. Some believe that indicates that we're possibly nearing the bottom of the cycle for builder sentiment. It should be noted, however, that there were many times where the inflation rate slowed only to pick back up the next month. As Jerome Powell has said multiple times, 1 month of data is meaningless. What we really need to see is a trend. And Americans already expect a worsening U.S. economy in 2023, with over 1/3 of voters saying inflation is causing them major financial strain. When asked if people thought the U.S. economy would get better, worse, or stay the same next year, more than 50% said it would get worse. The latest economic data shows that pricing pressures are easing in the United States as well as Europe, although the global economy continues to face the risk of a recession as demand weakens and business activity declines. The S&P's composite output index for the U.S. declined to 44.6, down from 46.4 in November. That index, which measures activity in services and manufacturing, remained below 50. Any number below 50 indicates a contraction in the U.S. economy. The data points to the U.S. already being in a recession. So if the U.S. is already in a recession, why hasn't it shown up in the economic data yet? While business surveys have pointed to a significant slowdown in the global economy for many months now, that is only now starting to show up clearly in the economic data collected by governments. Keep in mind that official economic data lags by as much as 6 months, so we may not know for a fact that we are in a recession until we've already been in one for 6 months or longer. Here are the major changes coming to the stock market in 2023. A recent survey showed that 21% of investors don't think that they're paying investing-related fees. The fact is, they're wrong. Investors do pay fees, but those fees are often hidden. For mutual funds and ETFs, those fees show up in the form of management fees that get pulled out of the fund's overall profits, and as a result, most investors don't even know they're actually paying those fees. For individual investors buying individual stocks, the fees often come in the form of payment for order flow, or PFOF, where middlemen, market makers, will actually collect the bid-ask spread, giving both the buyer and seller of the retail stocks the worst possible price. But all of that is starting to change and could change in a significant manner in 2023. Last week, the SEC proposed rules that would squeeze stock market middlemen. This would be the largest overhaul of the stock market since the mid-2000s. The proposals grew out of a review prompted by last year's meme stock trading in GameStop and other stocks. The changes would fundamentally alter the relationship between brokerages such as Robinhood and the high-speed traders that handle those orders, as well as the stock exchanges themselves. The broad idea motivating the proposals is to use greater competition for investors' orders in order to deliver better prices to retail investors, while also stepping up regulations of firms that profit from handling retail stock trades. SEC Chair Gary Gensler said today's markets are not as fair and competitive as possible for individual investors. These changes are expected to face opposition from brokerages and wholesalers who profit off of retail investors, including trading firms such as Citadel Securities and Virtu Financial. The centerpiece of the SEC's plans is to propose for brokers to send the small investor trades into auctions. This would enable a combination of high-speed traders, institutional investors, as well as hedge funds and pension funds to all compete to fill the orders for retail investors. As a result, retail investors should get higher prices when they sell and lower prices when they buy. Requiring these auctions would be a big change, however, and could take years to implement. Another proposal seeks to level the playing field between exchanges and wholesalers. The proposal wants to decrease the price increment between the bid-ask spread from 1 penny all the way down to 1/10 of a penny. That would have the effect of further decreasing the bid-ask spread, which would further help retail investors. Now that the rules have been voted on, that advances them to public comment, which will be available until at least March 31st before the agency can decide whether or not to finalize them. During this time, both retail investors as well as large institutions such as Robinhood and Citadel will have the opportunity to submit comments to the SEC regarding these proposals, after which the SEC will review the comments before deciding whether or not to make these rules final. Ultimately, this means $1.5 billion per year is up for stake. To put it simply, this new series of SEC rules are meant to address problems with equity market structure, particularly for small investors, when it comes to the practice of payment for order flow, or PFOF. The practice is rife with conflicts of interest and does not sufficiently compensate small investors. The SEC measures stop short of banning PFOF, but all of these proposals combined, if adopted, would significantly alter the practice. Individual investors collectively could stand to capture some $1.5 billion annually. That money would come straight from the pockets of brokers as well as market makers such as Citadel and Virtu Financial. Although spread out amongst millions of small traders, it isn't going to radically change anybody's life. An example of an individual's roughly $500 trade might have netted an additional 79 cents by moving from wholesale execution to a theoretical midpoint trade with an auction. While these rules could take years to implement, they could radically change the stock market and the way that we know it. It could cause better pricing for retail investors, but it also means that large corporations are going to lose out on billions of dollars in revenue every year. These rules will no doubt come under significant objection from Citadel, Robinhood, and many others who currently benefit from payment for order flow. So it will be important for retail investors to submit as many comments as possible to the SEC. There are no doubt many links online showing you exactly where you can submit those comments. And as the market continues to fall over recession fears, we closed an SPY put today for a 21% profit. If you want to learn how to make money as the market goes down, then be sure to join my coaching program where I will teach you how to trade options, especially multi-leg options, which are more profitable in the long run. If you're interested in making money as the market goes down, then schedule a call with an onboarding specialist who can walk you through the program. He can answer all of your questions and you can see if this is a good fit for you or not. You can schedule a call with an onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video with your friends and family so that they will know what's going on in the market as well. And make sure you hit the like button and subscribe. And if you want to know more about what's going on in the markets, then make sure you watch my last video that I uploaded here.